Assalamualaikum. Hi everyone. Now I'm going to discuss on the common test question of April 2022, question 2. Alright, this question is about the investment property, MFRS 140. Alright, as usual, this question consists of two parts, which is part A and part B. Okay, the total marks for part A are 5 and the total marks for part B are 10. That makes it all together 15 marks for this question. Alright, so let's check out part A first. Okay, so here in this question, it is given the information about the properties owned by this company, Limang Properties Berhad. Okay, maybe this is sempena Hari Raya Aidilfitri kot, ya. That's why the name of the company is so related to the favorite dish during Hari Raya. Okay, alright. So a list of properties owned by this company, okay, is given in this question, right? So let's check out what is required by the question. Okay, identify whether the above properties would qualify as investment property according to the definition of MFRS 140 investment property. Alright, so let's identify, okay, each and every list of properties given here, right? So for number 1, let me use the red color pen. Okay, 20 acres of land in Selangor in which 80% is used for its operating activities, and the balance is rented out to outsiders under finance lease. Okay, so should this land be qualified as an investment property? Okay, should we classify this land as an investment? Is this land qualified as investment property? Okay, so basically this land, right, does not meet the definition of investment property, because it is used for operating activities. Okay, and in addition, the land is rented out under finance lease. Okay, if the property is rented out under finance lease, it is not an investment property. Okay, so for property number 1, it is non-investment property. Okay, so you can just write non-investment property. Okay, for question number 2, okay, actually for property number 2, okay, property number 2, this property is actually outside the scope of our syllabus, okay, because this is related to consolidated financial statements, right? So we just ignore this property. Okay, property number 2 we just ignore. Okay, students will be given bonus marks for this question. Okay, so we just proceed with property number 3. Okay, a 25-story building in Selangor whereby 2 floors are used for office administration and business purposes, and the balance is rented out to outsiders under an operating lease. Okay, the whole building cannot be sold separately. Okay, so this building actually has dual uses, right? Okay, so 2 out of 25 floors, okay, are used for office administration, okay, and business purposes, while the remaining 23 floors, okay, are rented out under an operating lease. Okay, so if the property cannot be sold separately, we have to look into whether the portion that is used for office administration, okay, and business purpose is significant or not to the arrangement of the property as a whole. Okay, if you can see here, there are only 2 floors that are used for office administration. Okay, 2 over 25, that is 8% only. Okay, so that makes it 8% only portion that is used for office administration. Therefore, we can conclude that the portion is insignificant to the arrangement of the property as a whole. right? Therefore, okay, this building, okay, can be considered as an investment property. Okay, it is qualified as investment property. So you can just write, okay, this property IP. Okay, this one is an IP. All right, and we go to property number 4. Okay, a piece of land in Negeri Sembilan. Okay, whereby 95% of it's rented out. 95% of it rented out to outsiders under operating lease, and the balance is used as a site for its transportation facilities. The company cannot account the portions separately. Okay, this is also the same as the previous one. Okay, this is a property with dual uses. Okay, whereby 90% of the land, okay, was rented out under operating lease. Okay, while the balance is used for transportation facilities, right? So basically the balance, which is 5%, okay, is used for provision of services. Okay, so if the property cannot be sold or leased out separately, again, we have to look into whether the portion that is used for provision of services here, right, is significant or not. Okay, so basically the portion that is used for transportation facilities, okay, is only 5%. Okay, it is only 5%. Therefore, we can say that the portion is insignificant to the arrangement of the property as a whole, right? While the portion that is used, that is rented out under operating lease is significant, which is 95%. Okay, since the portion that is rented out under operating lease is significant, which is 95%. Okay, then we can conclude that this land is an investment property. Okay, so this land is qualified as an IP. So we can just write IP here, right? And let's check out property number 5. Okay, a 3-story building in Negeri Sembilan is used as a warehouse for its inventory. Okay, so this building is used as a warehouse. Okay, so warehouse is something that is related to business operation, right? It is also related to provision of services. Okay, so this building should not be qualified as an investment property. Okay, so for property number 5, this is actually a non-IP. Okay, because it does not meet the definition of IP. Yeah, it is used for provision of service, or it is used for the business operation of this company. Okay, so let's check out the answer. Okay, this is the suggested answer. Okay, you can just write your answer like this. Okay, for number 2, okay, students are given bonus mark. Okay, because the property given is out of the scope of our syllabus, so students are given bonus mark. Okay, so now let's proceed with part B. Okay, part B. Okay, let's read the question first. Lontong Berhad acquired a mega shopping mall on 1st July 2011, which was rented out to various other organizations under operating lease arrangements. Okay, let me highlight these words. Okay, operating lease arrangements, right? Okay, the shopping mall has an estimated life of 30 years and was measured at fair value. So we can say that the company adopts fair value model, okay, for this property. Okay, so since the property is rented out under operating lease, okay, we can say that so that means, okay, the property should be classified as an investment property, and also the company adopts fair value model, right, for the property. Okay, the trial balance at 31st December 2020 showed the fair value of the shopping mall was 8 million. right? So the fair value of the property on 31st December 2020 is also given, right? And then the company also provides the security and maintenance service at a total cost of 2 million per year for the tenants. Okay, so the company also provides security and maintenance services, okay, at the shopping mall, right? And then on 1st July 2021, the company converted the mall to office purpose due to company's rapid expansion program that demand in more office space. Okay, so it seems that on 1st July 2021, there is a transfer from the IP into PPE. Yeah? Since the building, the mall was converted into an office. The property, the investment property was converted into an office, right? And then on this date, the fair value of the building was determined to be 10 million. So the fair value on the date of transfer is also given, which is 10 million, right? And the company adopted the revaluation model for its owner-occupied building, and its depreciation is calculated based on monthly basis, right? Okay, so for the owner-occupied property or PPE, the company adopts revaluation model, okay? And the fair value of the building on 31st December 2021 was 12 million, right? So the fair value of the building on 31st December 2021 is also given. Okay, let's check out what is required by the question. Okay, A, prepare a statement of profit or loss extract for year ended 31st December 2021 and statement of financial position extract as at 31st December 2021. Okay, B, explain the accounting treatment in relation to the above scenario as at 1st July 2021 and 31st December 2021. Okay, so what happened on 1st July 2021 is that all right, there was a transfer or change of use from investment property to owner-occupied property or PPE. All right, so we need to explain the accounting treatment on the transfer from IP to PPE. Okay, on 1st July 2021, and we also need to explain the accounting treatment on 31st December 2021. Okay, so before we answer the question, let's check out the diagram that I've drawn for this question. Okay, so as you can see, okay, from this diagram, okay, the building was acquired on 1st July 2011. Okay, the building was acquired on 1st July 2011. Okay, and the fair value, okay, was given on 31st December 2020, which is 8 million, right? And we also knew that the company adopted fair value model, okay, for the investment property, okay. And then on 1st July 2021, okay, this is the date where the property, the investment property was transferred into owner-occupied property, okay, on 1st July 2021, okay. So from this date, 1st July 2011 until 1st July 2021, the building was used as investment property. But then on 1st July 2021, on 1st July 2021, okay, it was changed into owner-occupied property or PPE, okay, and the fair value is also given on 1st July 2021, that is 10 million. Okay, since this is the last date, okay, the last date, okay, of the investment property, ini kita kata macam hari terakhir lah, kan? This is the last date, apa tu, property tu menjadi investment property, okay. We still need to find the fair value gain or loss on IP, okay, on the date of transfer, okay. So we need to find the fair value gain or loss, okay, on the date of transfer, 1st July 2021, okay. And then starting from this date onwards, okay, the property has become PPE. Alright, and the remaining useful life on 1st July 2021 okay, is 20 years, right? Because the building has been used for 10 years already. Okay, so the remaining useful life are 20 years. Okay, and the fair value on 31st December 2031 is also given. This is the date after the property has become PPE, right? So since the company adopts a re-evaluation model, okay, so we need to find the we need to do revaluation on 31st December 2031 since the fair value is given. So we have to find whether there is a surplus or deficit on revaluation. Okay, and the financial year end of this company is on 31st December, right, 2021. Okay, another important thing that I would like to highlight here is that regarding the security and maintenance services provided by the company, okay, to its tenant. Alright, so in this situation, okay, we can say that the company has provided ancillary services to its tenant, other than renting out the property under operating lease. The company also provides security and maintenance services, or known as ancillary services or support services. Okay, the question is, should the shopping mall be classified as investment property since the company also provides services at the property? Alright, so usually when a company provides security and maintenance services, it is considered as insignificant services, right? Security and maintenance services or ancillary services are usually considered as insignificant services to the arrangement of the property as a whole, okay, unless it is mentioned that the company provide significant security and maintenance services. If the company provides significant security and maintenance services, then the property should not be classified as NIP. It is not qualified as NIP if the company provides significant services at the property. But since it is not mentioned, we can assume that the security and maintenance services provided are insignificant to the arrangement of the property as a whole. So the shopping mall is still qualified as an investment property since the mall was leased out to its tenant, to the tenant under operating lease arrangement. Okay, so let's answer required A. Prepare SOPO extract for year ended 31st December 2021 and SOPI extract as at 31st December 2021. Okay. Alright, so 31st December, Okay, so 31st December 2021, that is after the property has become PPE. Okay, so year ended 31st December 2021, the property has become PPE, right? So how do we prepare the SOPO and SOPI as at that date? Okay, so this is the suggested answer. Okay, alright. Okay, since we need to prepare the financial statement for year ended 31st December 2021, that means the financial statement should cover the period from 1st January until 31st December 2021. It should cover the period from 1st January until 31st December 2021. So, what happened during the financial period? Okay, so we know that on 1st July 2021, okay, so 1st July 2021 is the date falls under the financial period, the financial period of the financial statements, right? So what happened on 1st July 2021? Okay, there is a transfer from IP to PPE, so we need to find fair value gain or loss. Okay, this is very easy. Okay, if we use the fair value model, it's very easy. We just compare the fair value on the date of transfer, which is 10 million, with the previous fair value. Okay, this is the fair value given on the date of transfer, 10 million. So we just compare with the previous fair value, 8 million. So we know that there is an increase in fair value. Okay, that means there is a fair value gain, okay, on 1st July 2021 amounted to 2 million. Okay, the difference is 2 million. So there is a fair value gain due to an increase in fair value amounted to 2 million. So we can record the gain in the SOPO, okay, under other income. Okay, we can write fair value gain of investment property amounted to 2 million. Right? Okay. And then what happened after that date? Okay, the property has become PPE. Okay, when the property has become PPE, so from here, from 1st July 2021 until 31st December 2021, okay, the property should be depreciated. Okay, the property should be depreciated over its remaining useful life. Okay, so during the current accounting period, okay, from 1st July 2021 until 31st December 2021, there are only 6 months. Okay, the property should be depreciated for 6-month period already. 6-month period only. Okay, because the property was transferred in the middle of financial period, in the middle. So we should depreciate the property for 6-month period only. So we have to record the depreciation from 1st July 2021 until 31st December 2021. So how do we calculate the depreciation? Okay, we just take the fair value on the date of transfer, 10 million, divided by remaining useful life, 20 years, times 6 over 12 months. Okay, so we get 250,000. Okay, so the depreciation expense is 250,000. Okay, so you should disclose under expenses. Okay, under expenses, depreciation of PPE, 250,000. You can also show the workings like this, right? Okay, and then on 31st December 2021, alright, the fair value is also given for the PPE, which is 12 million. Okay, so since the fair value is given, we need to do revaluation on the PPE. We have to do revaluation. So in order to conduct the revaluation, we have to compare, okay, the carrying value with the fair value. So we need to find the carrying value on 31st December 2021. Okay, and we have to compare with the fair value 12 million. Right? So how do we calculate carrying amount? Okay, as usual, we have to find the we have to take the fair value here, 10 million, minus accumulated depreciation. Accumulated depreciation here is only for 6 months. Just now we already calculated the depreciation, okay, for 6 months, which is 250,000. Right, 250,000. Right, so we just find the carrying amount, which is 10 million minus carrying amount should be, okay, so this is the calculation for the carrying amount. Okay, the carrying amount, okay, carrying amount is the previous fair value, okay, minus accumulated depreciation, right? Okay, so the previous fair value is 10 million. Okay, so we just minus with the AD. AD is only for 6 months. Okay, we just calculated AD. We just calculated AD. Okay, 250,000. Okay, so we get 9,750,000. Okay, so this is the carrying value of the property, 9,750,000. So this is the carrying value. Okay, carrying value equals to 9,750,000. So we compare with the fair value on 31st December 2021, which is 12 million. So since the fair value is higher than the carrying value, we get a surplus on revaluation. Right? So the surplus is just the difference between the fair value and carrying value. Okay, so 12 million minus 9,750,000, we get 2,250,000. Okay. So we get 2,250,000. This is a surplus on revaluation. So since this is the first time revaluation or initial revaluation of the PPE, when we get a surplus, we have to credit into ARR. Okay, that's why under equity here we have to include the surplus under ARR amounted to 2,250,000. Okay, so this is the first time revaluation. So when we get a surplus, we have to credit into ARR. That's why the ARR should include the surplus. We should include ARR under equity amounted to 2,250,000. And don't forget, we also need to disclose PPE under non-current asset. Okay. Under non-current asset, we have to disclose the SOP at its fair value, 12 million. As at 31st December 2021. So the fair value of the PPE is 12 million. Alright. So we have done already. Okay. Required A. Okay. Which is to prepare SOPO and SOPI extract. Okay. Now let's check out required B. We have to explain the accounting treatment in relation to the above scenario as at 1st July 2021 and 31st December 2021. Okay, basically we just explain what we've done, okay, in the SOPO and SOPI just now. Okay, we have done what we have disclosed in SOPO and SOPI. We need to explain in the form of accounting treatment. Okay, so let's check out the suggested answer, right? Okay, this is the suggested answer. You can use your own words to explain the accounting treatment, okay, based on your own understanding. Okay, so let's check out the suggested answer, right? On 1st July 2021, the building will be classified as MFRS 116 PPE as there was a change in use, or as there was a transfer from rented out property to owner occupied property, right? Okay, so you have to mention that there was a change of use or transfer on 1st July 2021, okay, from rented out property or from investment property to owner occupied property. Okay, the accounting treatment in accordance with MFRS 140 investment property is to measure the owner occupied property in its fair value of 10 million on the date of transfer. Okay, so on the date of transfer, okay, the PPE should be measured at the fair value of IP, which is 10 million. The PPE should be measured at the fair value of 10 million on the date of transfer. And then the difference of fair value at the date of transfer and prior year fair value amounted to 2 million. Okay, is recognized as fair value gain in the SOPO, right? So just now we have already disclosed in the SOPO, we've got fair value gain on investment property, remember, amounted 2 million. Okay, so that one we can explain in the accounting treatment. The difference of fair value on the date of transfer and the prior fair value amounted to 2 million. You can show the calculation 10 million minus 8 million. Yeah. So this is a fair value gain which is to be disclosed in the SOPO. Yeah? And then the building is then depreciated over the remaining life of 20 years. So since the property has become PPE, okay, owner occupied property, okay, it has to be depreciated over its remaining useful life. Alright. And then you can mention the amount of depreciation. Okay, the depreciation of the building for year ended 31st December 2021 is 250,000, which we already calculated just now. Okay, the depreciation for 6-month period, okay, 250,000. You can mention in your accounting treatment. Alright, and then we also have to explain, okay, the revaluation. The revaluation that took place on 31st December 2021. Revaluation of PPE. Okay, so you can say on 31st December 2021, there is a revaluation of PPE. Okay, there is a surplus on revaluation of 2,250,000 since the fair value of 12 million. Okay, is higher than its carrying value. Okay, just now we already calculated. Okay, the fair value on that date is 12 million. We have to compare with its carrying value 9,750,000. So since the fair value is higher, then we get a surplus on revaluation, which is to be credited in the ARR. Okay. This surplus on revaluation. Okay. So as I mentioned just now, the surplus is to be credited into ARR. Okay. So this is the accounting treatment for the transfer, or the change of use from IP to PPE, okay, and also the revaluation of PPE, okay, on 31st December 2021. Okay, you can use your own sentence. You can also, you can use your own words in explaining the accounting treatment based on your own understanding. Okay, that's all about question 2. Thank you very much. Thank you so much for your participation. Assalamualaikum warahmatullahi. Have a good day.